let's set up that conversation because, of course, inflation has been a big topic, the dot plot, and the future path of interest rates, a big topic last week, and when we might finally get some tapering. We heard the official line from the Federal Reserve. Now we'll get more insight perhaps into who was responsible for which dot, because we got a lot of Fed speeches this week. Our Brian Cheung is here to help walk us through all of that. So we have some hints, we have some inferences. We know some of the dots already, but we're probably going to learn more this week.
Yeah, well, Julie, we need to rewind to last Wednesday's Federal Reserve announcement where they said that they'd be holding interest rates steady, maintaining that $120 billion a month pace of asset purchases. But of course, it was the dot plots that got everyone all excited about what the Fed's next steps might be and whether or not those steps might be coming earlier than expected. So if you take a look at the dot plot, which is a quarterly projection of where interest rates could be over the next few years, you can see that the Federal Reserve's median dot, again, the median member of that 18-member committee, projecting 2 rate hikes by the end of 2023. We got speeches or remarks from 2 Fed officials, Neil Kashkari from Minneapolis, who told, I believe it was the Associated Press, that he does not see the case for raising interest rates through 2023. So we know that his dot remains pinned at near zero. But we saw St. Louis Fed President James Bullard tell CNBC that he sees the first rate hike coming at the end of 2022. So you can start to shade in which dots are which Fed officials. Now, of course, this is going to be the major week where we start to see a lot of those Fed officials go out and make their public remarks. Some of them might be a little bit more willing to share exactly which dot was theirs than others. But of course, that could introduce a lot of volatility into markets depending on what they say, at least based off of the commentary and the reaction that we had gotten last Friday. Now, of course, we have Fed Chairman Jerome Powell set to speak tomorrow on Tuesday. That could be a counterweight to whatever the other Fed officials say, since we already know the Fed chairman's line since he shared that on Wednesday, saying that he wants to downplay the role of the dot plots and that everyone should be taking it with a big grain of salt. Again, that appearance will be on Tuesday on Capitol Hill. And then we also have a number of other Fed speakers, including New York Fed President John Williams today. Also pay attention to Mary Daly from San Francisco. She's a voting member of the FOMC. She'll be speaking tomorrow. But of course, guys, I'm taking a look at bond yields right now. Keep an eye this week through all of these Fed speeches on the 30-year bond, which has really been flirting with the 200 basis point level. Keep in mind, guys, that was as high as 222 basis points last Wednesday.
Brian, isn't New York Fed President John Williams, isn't his discussion or speech this week perhaps the most important outside of Fed Chair Jerome Powell's? Because he's still seen as a dove. Any hinge or tinge of hawkishness from him would not be a good thing.
Yeah, well, we're going to hear from Powell on Tuesday. We're also going to hear from Mickey Bowman. She's a governor at the Fed later this week as well. But outside of that, we're not hearing from some of the kind of people that you tend to see as the big hitters on the Federal Reserve Board in terms of steering monetary policy conversations, namely Rich Clarida, the vice chairman. We aren't scheduled to hear from him this week. So in deference to that, the New York Fed President John Williams, who has a permanent voting role on the FOMC, but is still one of those regional heads, he is likely to be the highest profile person outside of Powell to be speaking this week. He'll be speaking at 3 p.m. today. Now, of course, what his commentary is going to be remains to be seen. We will likely get some sort of speech text from him around that time. But when it comes to these dots, we have to remember that there's no obligation for these Fed officials to come out and let the media or let anyone that they're talking to know specifically, well, that dot for 2022 was mine, that dot for 2023 was mine. It's completely up to the discretion of the Federal Reserve officials themselves if they want to share which dot was theirs. Now, of course, we heard from Neil Kashkari, heard from St. Louis Fed President James Bullard about which dots were theirs, but the likes of John Williams, I don't expect him to be someone that would be likely to say, this was exactly where I charted my projection for the June summary of economic projections. And I think a number of other Fed officials might do the same. So for Fed watchers, we're going to continue to try to shade in which dot is attributed to whose, but we have to remember that it'll still likely be an incomplete picture because a lot of these Fed officials will probably reiterate what the Fed chairman was saying, which was, don't pay too much attention to the dot plots. These are just forecasts. A lot of things can change in the next year and a half or 2 years. So just remember that we are outcome-based, not necessarily outlook-based.
Brian, I'm also just curious how you've thought about the bond market in the last couple of days, because the reaction on Wednesday, the initial reaction to see yields higher was what you would assume would follow from a more hawkish projection from Fed officials, however you want to carve that. I think more hawkish is a pretty standard way to characterize what happened, especially considering inflation and GDP numbers, so on and so forth. But now we've seen yields come back in, and I just wonder if maybe the takeaway is that the market believed the Fed had to come meet it where it kind of has, and right now investors are sort of comfortable with today's forecast from the Fed with respect to rate hikes, maybe even next year.
Yeah, well, the bond market is going to bond market, and the reason why it goes up or down is the same type of speculation that you'll have with the equities market. It's not necessarily attributed to any one piece of news, but of course, when you see some of the large outside the regular standard deviation moves in the 10-year and the 30-year on the longer end, you do start to wonder exactly what's going on here. But what I've heard is that, yes, the Federal Reserve may have been the trigger for some of these moves, but they may have been amplified by certain bets that bond traders have been putting on treasury yields of longer duration. And one of those possible trades was just the curve steepener trade, where headed into the Fed meeting before we got that kind of announcement that the Federal Reserve was thinking or had already kicked off their discussions about tapering in that June meeting, which was a bit earlier than others expected, people were shorting the 30-year and they were trying to buy on the short end, which was hopefully, they thought, steepening the curve because they had anticipated that the Federal Reserve would be too late to raising interest rates, that they would ultimately have to see eye-popping levels of inflation before they pump the brakes, which would require maybe a 50 or 100 basis point at a time interest rate hikes. Now, of course, the Federal Reserve now doing the opposite of that, saying we're paying attention to this. In fact, we're going to pull forward maybe our timeline for raising interest rates, which caused a lot of those steepening trades to blow up. What happens is, in that case, if you were short 30-year, you now all of a sudden have to buy 30-year bonds. That then flattens the curve back out. You start to sell some of those shorter end treasuries. That's the reason why some of these flattening trades have continued to move the yield curve in a little flatter direction, which explains the falling yield on the 30-year, especially from 20 basis points higher where we saw in the middle of last week. So I think that it's a lot of kind of financial pressure that's also contributing to the moves that we're seeing, in addition to the Federal Reserve action itself. We have to remember quadruple witching was also on Friday, so there was a little bit of intricacies in the way that markets were moving, specifically at the end of last week. Now, whether or not that settles this week remains to be seen. We have at least 10 Fed speakers that are going to be out there into the ether speaking their minds, so that could introduce more volatility, less volatility. Who knows?
Brian, I was reminded this weekend about our level of market expertise and knowledge when I had a friend ask me, what is a Fed hawk and what's a Fed dove? I'll put that question to you since you are the Yahoo chief correspondent.
Yeah, I feel like we do tend to say, like, oh, it's the Hawks versus the Doves, and everyone's like, well, what is this, like a West Side Story kind of like terminology here? Like, what does that even mean? Well, Hawks generally refer to policymakers within the Federal Reserve that would be a little bit more in favor of tightening policy versus the Doves, who would tend to be more, they want more accommodative policy, easier money policies. So it's not necessarily as binary as, raise interest rates or lower interest rates, because in an environment like this, there's no other direction to go than up, right? So just because you're saying interest rates will go up, that doesn't necessarily mean you're hawkish. In the context of where we are right now at the zero bound, hawkish might be you want interest rates earlier than other of your colleagues, in which case the doves might be those that are advocating for, raising interest rates, but just at a later point in time. So it is much more about comparisons, but generally speaking, hawks refer to those that want to raise interest rates at a more aggressive level or try to normalize policy at a more aggressive pace than the doves.
Brian, I'm envisioning some really creative person on the internet with like members of the Fed in leather jackets and like the,
with like, a little snapping,
little West
right?
Side Story action. Yes, exactly. Please, someone out there on the internet, do that for us and send it to us. Thanks so much, Brian Cheung. Appreciate it.